One more share of the disclaimer, just so everyone who's joining sees that. All right. Awesome, D. You can take over the screen now.
Okay. So I think what we were going over is on the options chain. Let's just recap what we were doing yesterday. So on this options chain, I'm going to close this menu just to expand the screen. We were covering the different graphs that show the trading volume in the options. And these are just quick visual displays to get insights on the trading volume using graphs. Since we covered the volume, let's take a look at the open interest. So this is another visual representation of the open interest in the option contracts and whatever stock you're analyzing. And it's a quick way to kind of get an idea of where there's open interest, if there's a concentration of open interest in an expiration or strike, and so forth. So here, the default is showing us the open interest by expiration. So down here, SPY has a lot of different expirations. You could hover over it to get that expiration. And for each expiration, we see this stacked bar. The bar represents the total open interest in that expiration, including calls and puts. The calls are in the yellow, and the puts are in the blue. Okay, so we could see here that the open interest, 73% of open interest are in put options, 27% in SPY are call options. And now we could kind of see how that open interest is distributed. And it's very, clear that this one over here, October 18th, appears to have the most open interest for the available expirations, which, could be something maybe happening, or it is the next, monthly expiration. But there, of course, something that sticks out. The next one going out is December 20th. And in both of those expirations, it looks like there is more put open interest in the put options than the call. So you could see here I'm hovering over December 20th, 67% of the open interest in that month is in the puts versus 33% in the calls. Let's do the October 18th, 78% of the open interest is in the puts, 22% of the open interest is in the calls. So those two expirations stick out. And what the open interest is indicating is that there are established positions that people are carrying, right? So you could have a lot of volume, trading volume, let's say in a particular month, usually, the front months. But if people aren't carrying those positions, if they're just trading in and out of them and using the options, let's say just for very short term risk exposure or hedging, and then they close out of it, then if that's happening a lot, then the open interest will not, will reflect that. It won't grow. Here we see that there are positions that are still open, so that risk, is being carried by, certain parties out there. So now we could also look at how the open interest is distributed by strike. So are there particular strikes, even if we aggregated all throughout, right? Let's say we aggregated all the expirations. Well, is there a particular strike that people tend, to carry positions, even if we added all these expirations up? So we could look at this graph by strike. So I'm going to click on that. And now we see a distribution of open interest by strike. And of course, SPY has a lot of strikes. You could see here that the range, from 120 to 80. There are a lot of strikes here. It's a very popular um uh underlying, very popular ETF that people trade options on for many different reasons, some, including hedging, systemic risk, and so forth. Now, so looking at it, what and eyeballing it, right? So I'm just eyeballing it, and it is clear that a lot of these bars that really spike up, that look like they stand out, are mostly in blue, representing puts, and that they range. There's a big range, really, between, I don't know, I'd say like 520, 520, all the way down to 400. There are a lot of put open interest. So it's not like just one strike sticks out. There are a lot of strikes here with open interest that pop out. Okay. Now there could be spreads on there. We don't know by this graph. We don't know what the open interest is, because you could have like a put spread, right? So there could be a put spread that involves two strikes, like maybe this strike and this strike, and a put spread would involve, buying one option, selling another. So that it's not, from this particular graph, we don't know what what the trades were that led to these open interests. We just kind of get a sense of which strikes have the most open interest, right? And just knowing SPY, we could go back. I don't know if this is an unusual amount of open interest in the puts, but traditionally people could be using the SPY to hedge downside market risk, right? So you have a portfolio of different, let's say, different stocks. You could be trading like Apple, Tesla, Microsoft, whatever it is, right? Let's say you have this portfolio of stock positions. Well, once you create this portfolio of stock positions, your portfolio could have a systemic risk. Systemic risk means that the overall portfolio will have risk to the overall market, like a beta or correlation. If the market goes down, your portfolio is made up of stocks that are sensitive to that. You have that downside risk. It's systemic risk. It's not not just specific to that stock, but it has risk to the market. Well, how do you hedge that systemic risk? Well, you could use, something like an SPY to hedge off some of that risk. And that's what happens a lot in like SPX, or, SPY could be QQQ. So you'll have those types of trades in there too. It's not the only trades, but you'll have those types of traders too that will use something like SPY or SPX or QQQ to hedge off some of that market risk, systemic risk. So it may not be unusual to see it, to see the open interest looking this way. Now, well, we did notice, let's go to an expiration. I think we noticed one expiration here that stuck out as October 18th. So we could go just to that specific one. Let's go to October 18th here. Well, there's a lot of expirations on here. So here's October 18th. I'm going to click on that. So now we're looking at the distribution of open interest by strike. in October 18th, right? So we here now we see, that a couple stick out. Like here's a big one, the 410. So the 410 puts, has 156,000 contracts in the open. There's, another big one, 400 put, 127,000. There's like a little bit of a clustering here between 500 and 450. And then we got like this big one here on the 510 strike. If we get closer to where the 568, so here's here we are right now, 560, yeah, 565, 568. And here it does around here, the open interest doesn't seem as big, right? So nothing like clustering around the current spot price. It's really most of that open interest are, downside strikes, right? Which kind of start, the first one maybe hits around here, 561 strike, 560, but then you could see here, the next one will be like the 550. So this is a quick way to now just get an idea of where there's open interest in established positions that are being carried, right? So because there's open interest, these positions exist somewhere, and there's risk exposure on these contracts. We could also just take a look at the last 30 days. And if we take a look at the last 30 days, how the open interest in this expiration changed from day to day. So this is the total open interest in October 18th expiration. And we could see that it just kind of steadily goes up, on a daily basis. So if we saw, like, let's say, a bunch of zeros and then it spiked up one day and just stayed the same, then we would know that on one particular date, a big trading volume probably led to this open interest. But here we see that the way this open interest appears in the last 30 days appears to grow. It's pretty, just looks kind of like it doesn't move up and down. It doesn't look like it's just staying the same. It looks like there's probably trading going on a daily basis, and that the open interest seems to climb or increase as we go further in time, right? So it just, you start out here, and if you just go from left to right, you see it just kind of climbs up. All right, so and it looks to me like just eyeballing it that the put, right? So the call open interest does seem to be climbing a little bit too, but the put is climbing faster.
There's some discussion about the open interest and when it's updated. Rob says it's only updated in the after the day when everything's tabulated by the OIC. I'm assuming that is correct, right?
Yeah, the OCC, right? So
OCC, sorry.
yeah, so so let's talk about that open interest, because like I get emails sometimes. Well, is your open interest like real time? Does it update? How often does it update throughout the day and so forth? So there's a difference between trading volume and open interest that people have to understand. That when you have trading volume throughout the day, trading volume itself just climbs, right? So trading volume doesn't go down; it just goes up. So even if somebody, bought and sold a a a contract, that will increase the trading volume. So for example, if I bought a contract from Will, he sold it to me, that's one contract. And then if I closed out the same day, with Will, bought and sold. We have a zero position, but that's two contracts. So the volume will always go up, okay, throughout the day, unless they break trades, unless like the trade is broken. But the volume, trading volume, like this option volume, goes up. Open interest, though, can go up or down because open interest is the contracts that are outstanding that haven't either been closed or exercised or signed, expired. So that represents something different because if I closed out the same day, well, the open interest between two parties, then the open interest will be zero. If Will and I are the only ones that traded all day, I bought it from Will in the morning. Then I sold it back to Will at the end of the day. Well, now I don't have an option. Will doesn't have an option. Open interest is zero. Okay, so we're done. There's no more obligations. There's nothing on the books. So that's the difference between open interest and volume. You have to understand those differences. Now, how does open interest get calculated? Well, the options clearing corporation, they clear the options, right? They clear and guarantee all these options. And they calculate open interest based on settled trades at the end of the day. So trades are settled at the end of the day. Once they're settled, the options clearing corporation has to account for other things like, were there any exercises or assignments, right? So if somebody exercised an option, it's no longer open interest. It got converted to stock. There's no more option. Maybe there's a split. They have to account for that. If there's an expiration, they have to account for that, expiring options. So open interest itself is a overnight process by the options clearing corporation. They reconcile the settled trades, exercises, assignments, expirations, all this stuff. They have to reconcile, and then they create a report with the open interest. And I got to tell you, the options clearing corp, I've been tracking them, and they make mistakes. Sometimes they'll update the open interest, make corrections the day after or whatever. So if you track open interest and know the options clearing corporations, there's things in there that you're like, well, this doesn't make sense. And then like 2 days later, you see a correction. Because it's not like the options clearing corporation, it's not like the exchanges where they have to match up trades, and the options clearing corporation just works differently. So how often does it update? Well, once a day, right? If they have to reconcile overnight, right, and then they produce this report, the report gets made available usually the next morning, next business day, and then you have the new open interest to reference. It doesn't get reported intraday because the exchanges themselves, they don't know the open interest. They don't report it on the trade tape. They have no way of knowing what the open interest is because they don't clear all the options. They just handle trades and transactions. And the exchange itself doesn't know what's happening on the other exchanges, with the the NASDAQ exchanges are responsible for the trades on the NASDAQ. The American stock exchanges are responsible for the trades on the American stock exchange and so forth. So they're not responsible for all the other trades that are happening on the other exchanges, but they all get consolidated, and settled at the end of the day and get reported to the options clearing corporation. Then they handle that aggregation. So the open interest is available, once a day. You could infer sometimes that the open interest would be going up or down, because if you know that the open interest was zero, and there's one trade on the day that was 1,000 contracts, well, if it's only one trade, it would have to increase the open interest because there's zero before. Now you have this trade. For the trade to close, you need another trades unless they exercise it, unless it's an option that can be exercised. So you can infer like this one would increase the open interest. But all right, well, we're right up to 9:30. I'm gonna stop it there.
Yeah, awesome job, D. As always, thanks for the questions, everyone. Have a great trading day. Stay safe out there. Thanks, D.
Yep. Thanks, everyone. Stay safe and hope to see you guys. Wait, are we off?
Tomorrow. We do have a
yeah. Sorry.
yeah.
See you guys tomorrow.
No next exchange holiday. I checked because the kids have off this week. What holiday is it coming up? Was Rosh Hashanah? Rosh Hashanah.
Yeah.
So everyone
Okay.
if you're not here the next 2 days, we will try to be here. Everyone have a great day. Thanks as always, D.